Hey guys, welcome back to the channel. In this video, we're going to talk about what in the heck is going on in the stock market. We're going to go over this article from Yahoo Finance. As a quick read, it was released at about 3:15 this afternoon. And then we're going to also look at the charts of the S&P 500, look at TQQQ, the Dow Jones, everything like that. Kind of talk a little bit about what the heck is going on. So it says the panic button is nowhere in sight as memory of the 7th S&P rout fades. And it shows the charts of us popping up, falling down, popping up, falling down. And it says, worried? Yes, but the investors show few signs of panic amid the stock market drubbing that has wiped out $3 trillion, going by everything from fund flows to options trading. One sign nerves are in check as the S&P dropped more than 3% on Friday is that the volatility index, a measure of the options cost that's also known as the VIX, was stuck near 25, lower than in the 6 other instances this year when the stock sold off like this. Exchange-traded fund investors, disheartened by Federal Reserve Chair Jerome Powell's hawkish remarks at Jackson Hole, quickly pulled money out of stocks, yet at $1.2 billion, the amount of withdrawals was roughly half the daily outflow experienced around the market's June low. Light positioning among professional investors has helped keep emotions in check. Mutual funds are in defensive postures, parking money into cash, while hedge funds cut exposure ahead of the market catalysts such as Powell's speech and looming data on employment and inflation. The lack of full-blown capitalization is a sign that the change is not over, especially when rule-based funds and pensions are expected to offload shares in the coming days. The market traded like hedges or monetized as opposed to adding during the move lower, said Danny Kirsch, head of options at Piper Sandler & Company. Positioning already short, meaning no need to add downside. Or investors hope this sell-off will be contained. Stocks extended a 2-week decline, with the S&P losing 0.7% on Monday. Traders continue to digest a flurry of hawkish remarks from the world's top central bankers. That inflation is here to stay, and that will require forceful action to bring it under control. The VIX added 0.65 to 26.21. Friday's sub-30 VIX close says that this week could be somewhat worse, said Nicholas Colas, co-founder of Data Trek Research. Another down 3+% day would not be surprising, and we suggest looking for a VIX close in the 30s before establishing new long positions. Sentiment was cautious and heading into Jerome Powell's speech on Friday, after a 2-month rally since mid-June forced short sellers to unwind wagers. During the week through Thursday, hedge funds tracked by Goldman Sachs Group were busy boosting short positions, particularly through macro bets like ETFs or index funds. They're selling in macro products over the stretch, was the largest in 8 weeks. At Morgan Stanley, hedge fund clients kept their positioning light. As of Thursday, leveraging among long-short funds stood at 43%, down from 48% 2 weeks ago, and lower than 88% of the time in the past 5 years. So kind of stop there as they kind of keep talking, a little bit more about, some statistics and things about that. But just kind of in general, like they mentioned, the VIX finished at about 25. We're going to look at it now and see exactly where this is. Really quickly, the fear and greed index, we'll take a look at that as well. So it's roughly about neutral, and kind of surprising that we're actually closer to greed than we are in fear. Okay, so which tells me that, that the market momentum is in extreme fear, but overall, as a whole, we're still in neutral, and it's more leaning towards greed than it is of fear, which is kind of crazy. I thought that we'd have more fear, but people may just be, kind of used to, or getting used to the overall market, market conditions currently at this point. So that's interesting. Let's take a look at the VIX. The VIX currently here at 26.21, like we mentioned in the article here. And typically this number, the closer it gets down to 0, and if it gets into the negatives, that's whenever this thing starts to continue to rise too. And kind of like the article says, I'll completely agree with it. When it gets to 30, around 30 or at 30 or a little bit above 30, that's when it's a good time to actually go and buy into some longer term plays, because eventually it's going to turn around and it'll slowly make its way down back to the lower 20s. and that means the stock market is kind of finding some recovery and the stocks are actually coming up. Okay, so let's take a look at the charts really quickly. Let's see what they're telling us. All right, guys, looking at the S&P 500, we're at about 40, 30, 61, and we're getting close to that red SMA line, which actually we're pretty much right where the red SMA line is, and we're undervalued or oversold. So I do expect this to bounce up and recover somewhat from right here and retest eventually somewhere in the 41 to 4200 level. I don't expect us to just go, obviously, it can't just go straight down. I mean, you could, but the reality and the realistic, the chance of that is kind of low. So at least we're going to pop our head up before falling all the way back down if we're going to do that. But if you look here, we crashed all the way down to 36.36 and made a nice little run all the way up to about 4,300. And now, I mean, this is a pretty decent little pullback here. But it's a good test to see, are we going to come down and retest at 3,800 level, or are we going to bounce off of that and kind of make our way forward? So this is a 180-day 4-hour time frame. We're going to look at a longer time frame. Now, this is a daily chart dating back to January of 2020, and as you see here, this is the COVID crash, bang, and and you see the huge run up we had from 2020 all the way to to here of 48.18. And the longer term time frame shows that we got all the way to that red SMA line here, got rejected right here at the red SMA line. Now we're pulling back down. So we still do have some room to run unless we can get above here and start moving above that red SMA line. We really could realistically go down and easily retest that 3,800 level right here, because you see we're not too undervalued just yet. So I expect if we're going to continue to go down, about 3,800, in my opinion, is going to be kind of a, you can't call the exact bottom, but I'm going to say that's where we find some good recovery, or even just kind of trade sideways for a while, because longer term on this chart, when you hit there, you're going to be undervalued or oversold, and that's when people will probably come start buying back in. But overall, we have to get above this red SMA line for a longer term to be back into a bullish pattern. As you can see, we're still in that bearish pattern. So anyway, guys, just want to provide you that update. Let me know your comments below on the overall market conditions. Other than that, we'll catch you in the next one.